Hi, everyone, and thank you for joining us today for the Student Loan Repayment and Refinancing session. My name is Migdalia Gomez. I'm the Community Engagement Manager here at the Harvard University Employees Credit Union, and I'll be your presenter today. Prior to being at the credit union, I used to be the Director of Student Financial Services at a four-year liberal arts school in Boston. Oversaw undergraduate and graduate aid, and prior to that, I worked for the state with helping families access higher education and financing it specifically. So you're in good hands today, and if I don't know the answer to one of your questions, I promise I will do my best to put you in contact or do the research for you. So before we get started, I'm just going to go over a couple logistics. We've been doing webinars for some time, so I know you're all probably experts on how today's webinar will work. So I will keep this pretty quick, but just so you know, you have been muted, so you can go ahead, and if you are doing something else, no worries, we will not hear any background noise from your end. And we will be submitting questions. You'll be able to submit questions through the questions panel. And just to make sure that it's working and that folks can hear me okay, please let me know, where are you joining from today? So what city, what town, where are you joining from today? I'm always interested. We've had some people sometimes join from different countries, some people that have joined from the gym, some people that have joined while they've been commuting. So please let me know using the questions panel, where are you joining from today? Wonderful. Awesome. Okay, so I see some folks joining from Boston. I see someone said Burlington, a couple of folks from Cambridge. Thank you so much for letting me know. That helps a couple of different things. Helps me know that you can hear me. And also this way you can also submit questions. You will get an email most likely by the end of the week, which will have the recording, so you'll be able to access that. And you will also get the slides and a couple of helpful tips and additional resources that we'll go over today. So if at any point you feel like, oh, I missed something, no worries, you can always ask, but also know that you will have access to the presentation. And we will do a quick survey. That just helps us continue these presentations. So who exactly are we at the Harvard University Employees Credit Union? Not everyone may be familiar with us, and our name can be a little tricky because it says Harvard University Employees in it. So all of you are not HBCU Harvard employees, you're BIDMC employees. So how does this exactly work? So we were created and we are Harvard employees, and we are essentially a benefit for the entire Harvard community, which includes all of the different teaching hospitals such as BIDMC. We are the same as a bank in the sense that we offer the same products. So credit unions will do the same. So we have mortgages, checking accounts, credit cards, savings accounts, auto loans, RV loans. You think of it, we probably have it. But the biggest difference is that credit unions are not-for-profit institutions, meaning that any profit that credit unions make, they give it back to their members. And at banks, your clients, at credit unions, your members. So that profit is given back in the form of lower rates when it comes to loans and higher rates when it comes to savings, and a lot of personal finance education, such as this one that we're doing today. Everyone that is a BIDMC employee is eligible to become a member of the credit union. You don't have to do anything special to be a member. You can open an account with as little as $5. And once you are a member, you're a member for life, even after you're no longer working at BIDMC. And once you're a member, anyone in your household is also eligible for membership. That's all that I will say specifically about the credit union, but if you do have anything that you'd like for me to clarify, just feel free to let me know using the questions. So we're going to talk about student loan repayment, and it is quite the popular topic, especially in the past over a year and a half, and continues to be a big topic. So we're going to break it down into 4 different pieces. We're going to talk first about understanding what type of student loans we have. Folks will use the word student loans interchangeably between federal, private, state. So we're going to identify which loans you may have. Then we're going to go into different repayment options. Then we'll talk a little bit about forgiveness. I know that's always a very common topic. And as employees at a hospital, you're eligible for a lot of options as well. So we'll spend some time on that. And then we'll talk about refinancing. Does it make sense for you? For some of you, it may. For some of you, it will not. I'm going to keep my presentation, always try to give you pros and cons for all of the different scenarios. Really, my goal is for you to leave here with some questions, some things that you're going to research, and I want folks to feel empowered. I did say that I want you to leave with questions because, by the end of this, you're not going to be experts. You're going to have some things, but you'll be given direction as to, okay, I need to figure out more about this, or I need to figure out more about why. So that's really my goal for today. So let's jump right into what is the first step, and it's really understanding the type of loan that you may have. There are 3 different types of loans: federal student loans, state loans, and then private student loans. Federal student loans are the ones you hear the most about typically on the news because those all go through the Department of Education. So recently, well, not recently, a little bit over a year now, but when the federal student loans rate was dropped to 0 due to COVID, that only affected the federal student loans. When there's talk about, loan forgiveness, that's all federal student loans. Federal student loans are subsidized and unsubsidized. They used to be called Stafford loans many, many years ago. Perkins loans, which are no longer awarded, but some folks may still have those. And then PLUS loans. State loans really will vary. Massachusetts has a Massachusetts loan. Other states may have their own specific loans. But once if a loan is state, it doesn't follow federal guidelines. It's similar to state versus federal laws. It's literally, they're just different. Then you have your private student loans. I like to think about these as private credit cards that you may have. A credit card with Bank of America versus a credit card with HUCU or a credit card with Capital One. Each credit card is going to have its own terms, its own rates, its own benefits. And that's the same when it comes to private entities. And even if the entity is a not-for-profit, such as a credit union, they're still considered private because they're not federal or state. So it's sort of private. Another way of thinking of it is other. It's another category of student loans. One of the things I already mentioned, and I'm sure for any of you that have federal student loans, you most likely already know this, is that the federal student loans, so those are the subsidized and unsubsidized loans, the PLUS loan, the Perkins loans, the interest rate was set to 0. And it has been extended now twice. This screenshot actually doesn't have the most recent one, but it was extended through the beginning of next year. One of the best resources is going straight to studentaid.gov. Fortunately, because this is really something that has never happened before, it does get a lot of media attention, so you can just, once changes happen, it's essentially all over the media. But the main source to go where everyone is getting their information is federal student aid. And the website is studentaid.gov. I recommend, if you're not quite sure, or if you hear something on a website or see something online through social media, just go straight to studentaid.gov because that's where you're going to get the source. And it's pretty, as you can see here from this screenshot, it's pretty straightforward. It's pretty easy to follow. I will say for some folks, if you made any payments, so if you have those federal student loans and you didn't realize that you did not have to make payment, or maybe you thought, you know what, I can make payment, let me make payment, but your financial situation changed and now you're in a situation that you actually need those funds, you are eligible or can request a refund of any payments that you've made as of March of last year. So if I made $1,000 in payments, my financial situation has changed and I actually need that cash for something else, maybe an emergency, whatever that situation may be, all I need to do is contact my servicer, and that is the company that you pay your federal student loans to, and request a refund. They will issue that pretty quickly to you. If you're not in a situation that you don't need it, you definitely don't need to take it, but I do like to mention that because sometimes financial situations will change and maybe folks made payments and now realize, ooh, I actually really need those funds. There's no penalty for making no payment during this time because the interest rate is set at 0. So I talked a little bit about the types of federal student loans, but I wanted to go a little bit deeper into all of them because understanding the loans really will make a difference when we talk about the repayment and refinancing strategy. The federal direct subsidized and unsubsidized loans, these are the loans that if you completed a FAFSA, a free application for federal student aid, you would have been awarded these loans. You would have had to accept them, and these would be only in the name of the student. The federal direct subsidized and unsubsidized loan follows the student's education. So if a parent was paying for school, they would not have these loans under their name. So these are only awarded, only the student is the borrower of these loans. There was no credit check that was required. If you did undergrad and grad, you wouldn't have subsidized loans for graduate school, unsubsidized, well, depending on when you attended, but as of maybe over close to a decade or so, subsidized loans are only available to undergraduates. Graduate students have unsubsidized loans. Undergraduate students could have both subsidized and unsubsidized. But what exactly is the difference? Well, a subsidized loan, the government is paying the interest while the student's enrolled at least half time. Unsubsidized loans, that interest is accruing, but you're not responsible for that interest until 6 months after graduation, or you stop being enrolled at least half time, and that is the grace period. The rates for the student, for the federal subsidized and unsubsidized loans will vary, and it can be a little bit confusing. So let's say that we all attended traditional 4 years of undergraduate college, and we borrowed subsidized and unsubsidized loans each year. We would have borrowed 2 loans each year. The subsidized and unsubsidized loans would have been different loans each year. Depending on what year you attended school, those could have been different rates. So some of us we would have 2 loans per year, subsidized and unsubsidized, assuming we had financial need. That's what you need to get subsidized loans. Then for 4 years, that would be 8 different loans that we would have. That means that we could have 8 different loans for our undergraduate education at different interest rates. Any of you that have noticed where you're making payment, like, oh, I have 1 loan for this amount, 1 loan for this amount, and this interest rate, could be because the subsidized and unsubsidized weren't or aren't the same for all 4 years that you're in school. They typically will change year to year, and depending on when you attended school, your subsidized and unsubsidized loans could also have been different per academic year. And I know it could be a little bit tricky, but I'll give you some resources to help sort of straighten this out. Then you have the Federal Plus and Graduate Plus loan. These loans are, if you are or were an undergraduate student, the Plus loan would have been taken by your parent, and it could have been biological parent or a step parent. They would have borrowed that loan on your behalf. It would not have been a grandparent, an aunt. It's only a parent or a step parent. That Plus loan, however, would be under the parent's name, would not be under you as a student. Often get the questions, well, my parent borrowed the loan, but I want to repay it. Technically, you can repay anyone's loans. You can decide to repay your neighbor's loan, a colleague's, but that doesn't mean that it's going to appear on your credit report. So you could pay that parent plus loan, but that's not appearing on your credit report. That plus loan is appearing on someone else's credit report, on that parent that borrowed that loan. You cannot transfer that loan over. There are times where some students would borrow a new loan with the parent and have both of them be on the loan, but that you can't transfer the loan. It will continue to be the loan of that specific parent that borrowed it. And then if for those that attended graduate school or are thinking about attending graduate school, there's the Graduate Plus loan. That one is under the student's name. So this one doesn't have anything to do with the parent. This is specifically a loan that is awarded and graduate students are able to borrow. Private student loans, these really depend. I really think of these as credit cards. There are so many different credit card companies out there. There's so many different offers. And that's essentially what has happened with the private student loans. There are many different lenders, and they can each have their own interest rate. They can have their own benefits. Some private student loans will offer a cosigner release option, meaning that if you and your parent borrowed a loan while you were in undergrad and you've made, let's say, 4 years of payments on time, or 3, really depends on that specific lender, you can contact the lender and ask for your cosigner to be released from that loan. In that situation, that loan is no longer under that other person's name. It would solely be under your name. They're also and this is very common for most loans, even if it's even federal and state loans, that they will offer an interest rate reduction with auto pay. And this is actually not even tied just to student loans. This you can see across the board. So if you do have any other loans, I would encourage you to see if you can get a discount by paying it, setting up auto pay. And typically the discount is about 0.25%. Sometimes it's a little bit higher. And it may not seem like a lot, but you know what? That 0.25%, especially after many years of repayment, that's saving you hundreds, sometimes thousands of dollars. May not seem like it, but every little saving, at least I know for myself, I would rather have that money go to repay my loan faster or have that money in the bank than have to give it to a lender. The best thing that I would recommend, especially if you're not quite sure what type of student loans you have, is to just go onto studentaid.gov. Under the studentaid.gov navigation, the manage your loan section, here you'll be able to see any federal student loans that you have. This is going to be helpful because as I talk about the other benefits, the benefits of federal student loans and possible forgiveness options, these are applicable to federal student loans. So you want to make sure you know what loans you have and if these benefits apply to you. If you think you may have borrowed some other loans, or honestly, even if you're not quite sure, the other best thing to do is pull your credit report. I hope that folks are taking notes and maybe making a little bit of a to-do list. And if you are, and if I would say add this to that list, is pull your credit report. Go to annualcreditreport.com and see what student loans you may have there. This is important, especially if you weren't as involved in your undergrad. I used to work in a financial aid office, and we used to tell the students they would sign for these loans. Sometimes so they would co-sign with the parent, and they weren't quite sure what they borrowed. So we always told them to pull their credit reports, and I still encourage people to do that today, especially if you weren't quite as involved, or maybe there's a lot going on in life. So maybe you thought you had paid off a loan, or maybe just forgot about one. It's a good thing to do. And it's not just for your federal student loans. You'll also be able to see any other debt that's out there, especially if you've lived in multiple apartments. Sometimes we've seen small things like a Comcast or some other utility bill that is on someone's credit report for like $300, but it's sent to collection and then it negatively impacts your credit score. So just take a moment. It's pretty quick to do. Just go to annualcreditreport.com. You can pull your credit report. Pre-COVID, you could do it once a year for free. As of right now, through April of next year, you can pull your credit report once a week. I don't think you need to pull it that often, but I would at least pull each of the bureaus, Experian, TransUnion, and Equifax, at least once to see what student loans you have under your name. You'll also be able to see if you have some that are with someone else. This is especially important if you're thinking about possibly refinancing up at one point, or even if you're trying to buy a house or do any major purchase in the future. It's always good to know where you stand with your student loans and your credit report. So now that we have a better understanding of the type of student loans that we have, let's talk a little bit about what the repayment options are. A lot of the repayment options that I will focus on, and I should say like most of them really, are going to be federal repayment options. That is because the federal ones are standardized across the board. If you have a federal student loans, these are available to you depending on the loan that you have. Private student loans depends on the lender, and it also depends on when you borrowed that loan. It could, it's almost like a mortgage. It's almost like a credit card offer. It's almost like a car loan. Those terms change year to year, sometimes even more often depending on the market. So with the federal student loans, there are essentially two types of repayment options. You have the basic repayment plans. These are the traditional ones. You have a standard repayment, meaning that I'm going to owe the same amount for 10 years. So starting with my first payment through the last payment, I'm going to make the same payment and I will be done in 10 years. Then you have a graduated, which means I'm going to gradually pay a little bit more. And I shouldn't say a little bit more, sometimes it's substantially more, but I'm going to pay more every 2 years or so. The reason for the graduated is that this payment plan was made with the assumption that most people are making less out of graduation, and then as their career progresses, they'll make more and be able to pay more. And then you have an extended. Standard and graduated, these 10 years, we'll talk about forgiveness in a couple of slides, but if you're in one of these, you would be done with your loans in 10 years. So there would be nothing to be forgiven because under these plans, these would be paid off. Then you have extended. That's here you can see it more than doubles the repayment to 25 years. And then you have all of the income-driven plans. These are pretty complex because they vary based off of the type of loan that you have, how much you have. But the takeaway here is if you have a significant amount of student loans and you define what significant is, that would be an amount that you would be unable to pay, or that it's a challenge to pay given your current income, you could qualify for an income-driven plan. These are also the plans that are getting a lot of attention in the media recently, and I should even say recently, more recently, but they've always gotten a lot of attention because more and more plans continue being added. So there was pay as you earn, then there was a revised pay as you earn, and there have been talks. We don't know what's going to happen. We'll see in the next couple of months, maybe years, but there have been talks about condensing all of these. As of right now, these are what they are. It takes some time to make big changes, so I don't anticipate any changes that quickly without folks being notified of it. But do know that if you are in one of these income-driven plans, you could qualify for public service loan forgiveness. And that makes sense if we go back to this whole public service loan forgiveness. You have to have made more than 120 payments or more than 10 years. If you're in a standard or graduated, your loans would be paid off in that time period. Income-driven plans, 20 to 25 years, that is when you would potentially qualify for public service loan forgiveness. Now, in addition to having various different income-driven plans and also having the traditional payment plans, you also have federal deferment. So as you're enrolled, and this is especially important if you're thinking about going back to school, know that if you have federal student loans, one of the benefits is deferment, meaning that as long as you're enrolled at least half time in a program, your loans, you're not required to make payment. That is something that, right now, people are not required to make payment because of COVID, but before COVID, even during COVID, you're not required to as long as you're enrolled at least half time. This is a great option if you are going back to school and need to have increased cash flow. Do know that even though you're not making payment, the interest for unsubsidized is accruing. Forbearance is an option if you don't qualify for deferment. So let's say you're not in school at least half time, then you do have the option to postpone repayment. The takeaway here is contact your servicer. And again, the servicer is who you pay. They are the ones that are essentially managing your loans on behalf of the Department of Ed. Contact them if you're unable to make payment, because there are options available to you. And it's best to contact them before you miss any payments, because the consequences of missing payments are just not good. It's the government, so they can come and intervene. So I've used to prepare taxes for folks as a volunteer through IRS, and we saw that individuals would have their federal refunds garnished, or sometimes Social Security benefits, or even their wages. That's something that we have seen. So it's definitely, if you're in a situation that you're unable to pay, it could impact your credit score. It will impact your ability to borrow in the future. That's something too that we've seen, people that haven't made payment and then they want to go back to school. The federal government isn't going to allow you to make payment. So takeaway here is there are many different options. So if you're ever in a situation that you cannot make payment, contact your servicer. We have some resources too if you need help with what options are available. Green Path, which I'll give you the information to in the next couple of slides, they can also help you through that process. So we're going to jump into forgiveness now. And this is something else that has been in the news recently. Student loans really has been getting a lot of attention lately, but specifically the forgiveness and discharge options, most people don't usually qualify for these. One of the ones that has been in the news recently is this closed school discharge. So what that means is if you attended a school that was a participant in the federal student loan program and that school closed, your loans are forgiven. Part of the reason that has been in the media was that some hadn't been forgiven, and fortunately they were because they were supposed to be. But if you did attend a school and now that school is no longer a school, you can have your loans forgiven. But most of these, it usually doesn't impact most borrowers. And the one that most people care to learn more about is the public service loan forgiveness. And I will, as I said, I know some folks joined a little bit later, you will get a recording. You'll also get an email, and the email will have the slide and you'll be able to access all of these. Unfortunately, I'm not able to put these in the chat as we're speaking. As you can see, the URLs are pretty long, but if you want to get the information, you're more than welcome to do a screenshot now or just go to studentaid.gov and follow the breadcrumbs to get to this page. But public service loan forgiveness, this is one that we get a lot of questions about. And I'm going to start off with, because you're BIDMC employees, you're all eligible for this, assuming you're working more than half time. Now, what exactly do you need to qualify outside of your employer? Well, the monthly payments, this would mean that you would have your loans forgiven after you have made 120 qualifying monthly payments. A qualifying monthly payment could be a $0 payment. So if right now during COVID, if you aren't making a payment because you're not required to, that is actually a qualified monthly payment. So this is something else to consider. If you are close to that 120 payments and you believe your loans might be forgiven, that could be a reason to request a refund if you made any payments during this time because you weren't required, and you can have those loans forgiven. So you don't have to make a payment during this time to have those $0 payments can and do qualify for monthly payments. The 120 payments do not have to be consecutive. Typically 120 payments would be 10 years, but you may have gone to school, you may have, maybe not made a payment 1 month that was qualifying, but the next month it was. So they don't have to be consecutive, they just have to total 120 payments. The repayment plan, the only one that is currently granted is it has to be under a qualifying repayment plan, which are the income-driven plans. There have been some exceptions made with some standard repayment plans, but typically the ones that qualify are income-driven plans. And that makes sense if we think about you need to have that 120 payments. If I'm in a traditional payment plan, which is a standard, my loans would be done I would have no payment after the 120th. So the ones that would qualify are the ones that are income driven and that are extended outside of that 10-year mark or 120. And as I said before, because you work at BIDMC, you are eligible per your employer, but you would also need to be working full time. You also do not need to be at the same employer when you're making those qualifying monthly payments. So I could have worked at Harvard for 5 years and made 60 qualifying payments, and then I could go to BIDMC, make the other 60 qualifying payments, working full-time at both, separate different times. Then that would be 120 qualifying payment. You also could be technically at a qualifying employer, let's say Harvard, then you go to, I don't know, CVS, a McDonald's, something that's not a qualifying employer. You could make payments during that time, they wouldn't qualify. So if I had made 60 payments that were qualifying under Harvard, then I go to another employer, like a for-profit institution or a for-profit business, that those payments that I make during those time that time does not count. But then when I go back to a qualifying employer, so maybe I go there from the CVS or McDonald's, wherever I said, from there I go to BIDMC. If I had already made 60 payments and now I make 60 more, those additional payments would count. Now there's a lot here, so feel free, if there's anything that I can clarify, please let me know, put it in the chat, and I would be glad to help. There are a lot of good resources out there. The best ones are always going to be straight from the federal government because they're the ones that are the controllers of the information. They've put a lot of work recently in improving the information that they're presenting to folks. Studentaid.gov is going to be the best place to get more information about public service loan forgiveness, and that's known as PSLF. If you do have a pen or open it another browser as you're on this webinar, I would go to studentaid.gov/PSLF. Here you'll be able to actually log into your federal student loan account. You can see if you qualify, and you can even start completing the process, the eligibility form. That doesn't mean that you're actually applying for forgiveness, but it means that you're going to start the process. That is helpful because they can start to tell you how many of your payments are qualifying. And it's fairly simple. You don't have to do much, but you can do that. Okay, I had a couple of questions come in about the refund. Does it go against you if you get a refund? It does not. You are not required to make payment. A lot of student borrowers did not know that, so a lot of borrowers prioritized making student loan payments, and as a result, you can just get that money back. It does not hurt you. If you do qualify for forgiveness, right now those payments are qualifying. So if you didn't have to make payment and you did and you qualify, I would definitely get a refund, because if you gave them $1,000, but you're going to have your loans forgiven, even if you hadn't given that $1,000, better to have that $1,000 in your pocket. Yeah, because you're not being forgiven for the amount. Well, you are forgiven a certain amount, but it's not based off the amount that you've borrowed. It's after 120 qualifying payments. So the moment you've hit that 120 qualifying payment, that balance is going to be forgiven. So if I make 120 qualifying payment and I have a balance of 5,000 or I have a balance of 6,000, that regardless, those balances are going to be forgiven. So if you did make payment and didn't need to, you can definitely contact the servicers to get it refunded. It will not hurt you, doesn't count against you, but as always, definitely confirm, double check, triple check. But it from everything that's been out in the news, all the trainings I've attended, everything that the federal government has said, it will not hurt you, doesn't count against you, but always, triple check with that person that you speak to when you request that refund. And talk about refinancing. Folks sometimes think this is a great idea, others it may not be. So who does this make sense for? Well, before we talk about does it make sense, let's talk about what exactly is it. Refinancing is when you take a loan from another company and bring it from one to the other. Now, you can do a couple of different things with refinancing. I could take all of my federal loans from the Department of Ed. Let's say I have $15,000 that I owe them. I could take that $15,000 and I can bring it over to HBCU. So HBCU would pay off the Department of Ed. I now owe the Department of Ed $0. Instead, I owe HBCU that $15,000. Or I could take the $15,000 that I have from the Department of Ed, and maybe I have some private student loans from Sallie Mae for $10,000. So I could take the 15 and the 10, $25,000, bring it to HBCU. HBCU pays off the 15 and the 10, and now I owe HBCU $25,000. So your amount that you owe does not change. It's who you owe that money to that changes. You can do federal and private. You could only do federal, you can only do private. You determine, you choose what loans you want to refinance. Now, why would you want to refinance? Typically, the main reason people do it is because you're going to have a lower monthly payment. And the way you get a lower monthly payment will typically be because you're going to get a lower interest rate. Private entities typically can offer lower rates than the federal government. outside of these times, no one's giving you money for having your student loan, so you're not going to get like a negative interest rate. So outside of the 0% rate that the federal government has, typically the private lenders can offer lower rates. But how are they able to do that? Because they're not giving all the other benefits that the federal government is. So that's something to keep in mind. If you have federal student loans and you think you can qualify for private student loan forgiveness, or maybe you think that you're going to go back to school and you want to take advantage of the deferment while enrolled, or many other reasons, any other benefits, you need an income-driven plan. The moment you go from a federal loan to a private student loan, you've lost all of those benefits. I like to think of it as when you switch apartments, when you move from one house to another. If your current home has a dishwasher and you go to a new place that doesn't have the dishwasher, you cannot go back to your old place and get the benefit of that dishwasher. No, that's, you don't have those keys anymore. You're not allowed that benefit. The same with concept when it comes to your private your federal loan, or even if it's a private loan. Once you've paid off or closed the loan with that company that was the original holder, those benefits do not carry over. The new lender may have their own benefits. The new lender may have a dishwasher. They might have a washer and dryer in the unit. They might have a huge backyard in the house that you bought. There are all these different benefits that could be in the new home or the new loan that you go with, but that you would find out during the application process. Other reasons for refinancing, I mentioned earlier the possibility of having multiple loans through undergrad, or especially then if you add graduate loans. It's sometimes just easier for folks to manage one big loan versus having multiple loans and multiple interest rates. It's just the simplicity of it all. With refinancing, there's usually no application fee, and you don't have to get penalized for paying it off early. It's not common for that to happen, especially in Mass, because of the other laws that protect us, but you always want to triple check if there are any prepayment penalties. So if you are in a situation that maybe you get a bonus or get a promotion or a great refund or a tax refund one year and want to apply those funds, you want to make sure that there are no prepayment penalties. And typically what a prepayment penalty is, a lender could charge you a fee for paying off the loan earlier. Again, not very common in the state of Mass, or I should say it's not allowed in the state of Mass, but you want to make sure. There is something known as federal consolidation, and this is different than private refinancing. Federal consolidation is if you take all of your federal loans and you have, let's go back to that example of 8 loans while you were in undergrad. And instead of having 8, you wanted to add 1. You could do that with the federal government, but highly recommend that you do not do that, or at least talk to the servicer, talk to a student loan professional before consolidating if you are under the Public Service Loan Forgiveness Program. The reason for this is if you consolidate, let's say that I have made 119 payments and I did not consolidate my loans. Then I consolidate. Now, all those 119 payments that I've made, they've been wiped out because now it's a new loan. Even though, yes, it's through the federal government, it is a new loan, and I would have to now start the clock all over to reach that 120. So if you are considering public service loan forgiveness and you have made payments already, most likely you probably don't want to consolidate. If you've only made 1 or 2 payments, yeah, maybe you lose 2 payments, but the simplicity might be worth it. But if you've made significant amount of payments, you probably would want to hold off or at least have a conversation with someone to help you understand the implications of federal consolidation. And a couple of other things to just consider when you are thinking about refinancing. I went through a lot of these. It's not for everyone. If you are going to be taking advantage of public service loan forgiveness or deferment or any of the other benefits that come with the federal loans, probably not worth refinancing. And also the repayment term, it typically will begin right away. So if I just graduated from any program, undergrad or grad, I usually will get 6 months of deferment. I say usually because that's assuming you haven't used it already. But let's say I have not, then I get 6 months of deferment. So if I graduated in May, I don't have to make payment until typically November. But if I decide to refinance in May with a private company, I would probably make payment around June, sometimes July, depending on when you do it in May. So if you are thinking about refinancing, most people would probably wait until their federal deferment is over. That way they have that additional time period to not make payments. But if you have the cash flow and can, you may want to choose to make it to do the refinancing earlier. I've mentioned this organization a couple of times. GreenPath Financial Wellness, they are the ones that can provide free credit counseling, free budget counseling, and also free federal student loan counseling. The free piece usually throws folks off, like, how is this free? Well, it's free because we at the credit union pay for it. So as I mentioned, the Harvard University Employees Credit Union, we are not for profit. We are here to help all of the Harvard affiliates and employees, so that includes everyone at BIDMC. So we pay for this service, so it's available to you and those in your household as well. If you want to speak to a professional, have someone go over your federal student loans, have someone go over your credit report, or help with budget, or maybe just give you a, hey, you're doing a great job, do a little financial checkup, you can contact them. They're open 6 days a week, Saturday hours, and then they're open late on the weekdays until 10 p.m. on some days. So pretty flexible hours given folks different schedules. And all you have to do is mention the credit union. You do not have to pay for this. They do have some services that they charge for, but the federal student loan counseling, the initial one, and the budgeting and credit, all of those are for free. They also do general debt repayment as well. Now, I'm a numbers person, so it helps to just see all the different possibilities. So here's an example of a possible repayment strategy. And I did get a question if you need to be a member to call GreenPath. You do not. We definitely would love to have folks become members, but we understand that not everyone needs to have a credit union, and some of you may already have one. So we do make GreenPath available to everyone, including those that are not members. So if you have a current loan, let's say it's $40,000, interest rate 8.5, which is pretty high interest rate for a student loan, so that you're aware. Your monthly payment, it's about $552. Loan terms, or the remaining amount to go towards that loan, would be 8.6 years or 103 months. And that would be what the interest paid would be if you do nothing with the loan. This calculation, we just did it using our calculators. It's hbcu.org/calculators. You can also just essentially Google loan calculators. If you haven't done this, I highly encourage you to do this. I'll be honest, it's not fun to see how much you would pay in interest. It's an alarming number. You know, you think, oh, I have 40,000. Yeah, I can get that done. Then it's like, wait, that 40,000 is going to cost me how much in interest, or 16,000? But it does help, especially with our behavior, because once we know how much interest we're going to pay, most of us are more likely to make changes to try to minimize that interest, because pretty sure everyone here can think of something else to do with $16,000 and give it to a lender. Yeah, even if it's a little bit that we can save, it all makes a difference. So how can we bring that number down? Refinancing is one option. Here you can see by bringing down the interest rate 3%, you are going to reduce your monthly payment. So it's going to help increase your monthly cash flow. And something that I want to point out, when you refinance, they'll give you, typically it's 10, 15, depends on the lender, you'll get a new repayment term. You don't get the same one you had before. So in this case, the loan won't be paid off until a little bit later on. So an additional year and a half basically, but you still save $4,000. However, if you wanted to, and if you're able to still make the same monthly payment as before, if you can still make that $552 payment, but at a lower interest rate, you can actually be done earlier and save even more. In this case, you're saving about half. So it is half in interest. So it's a significant amount, and it may not seem like that, but that's why I say even a quarter of a percentage, anything you can do to reduce that interest rate, especially at the beginning of the loan, when that loan balance is higher, will help you pay off that student loan faster, so you can be done with your student loans. And if you are able to pay a little bit more, in this case, might not seem like a lot, just instead of $552, go up to $575. It still saves a couple $100 here and there. And this is something I used to do periodically. I would put it on my calendar and just increase my student loan payments by $25 or $20 every 3-4 months. It added up and it definitely helped me pay them off sooner. So it's something that I encourage folks to do. A question came in, is it recommended that we wait until the government, a person said forbearance, but I believe they mean deferment, has expired before applying for the loan forgiveness? I would not, so if you're thinking you would qualify for public service loan forgiveness, I would still go to studentaid.gov/PSLF and use that public service loan forgiveness tool even before your deferment is done. It's going to be good because then what happens is they're going to put you with a different servicer, which is up in the air who that will be because that servicer is changing end of this year. But it's good to then have you in the system, and it would be better for you because then your payments can start counting when you do go. And unfortunately, these things do take time. And as I mentioned, some of the some of the servicers that the Department of Ed has worked with, they're not going to be working with them anymore. So there may be some backup. That's definitely something that we've heard even before COVID. So definitely wouldn't hold off. It's always good to start the process early. And thank you everyone for these questions. And you may have a question and I'm sure someone else does, so it helps all of us when you submit these questions. We do have on our website a student loan repayment worksheet. It just has a couple of links and some helpful information. As I said, you'll get all of this in our follow-up email, but you can also, and I will put this one in the chat so that you also have it. This is a short one, so I can put it in quickly. So that one is now in the chat if you want to download this. And I did mention at the beginning, we do have a survey. So if you have any feedback, this is one of many sessions that we do with BIDMC, and we go through those surveys. A lot of the presentations that we've put together have been based off of feedback from individuals like, oh, this would be helpful, that would be helpful. So definitely encourage you to submit a survey. We don't take offense. If there's something I could have done better, something you want us to do more or less of, let us know. And there are additional workshops, including videos, that you can see on our BIDMC page, same page that you registered for this one. I know there was a lot that I just went through. We still have time. I purposely wanted to allow more than enough time so that if there are additional questions, I can answer those. As I give folks time to submit the questions, I'll just do a quick little recap of sort of what the next steps are. I know for myself, it can sometimes be overwhelming to go to these sessions and then kind of be left like, well, what do I do now? So I'm gonna help you out with this. I would say the first thing is do your homework in the sense of understand what loans you have. The repayment chart that I put on in the chat, you can get that off our website, or just create something in Excel or piece of paper and pen, whatever. You know how you work best. So whatever method you want, just list out, this is the loan that I have, this is the amount that I owe. Use a calculator to see how much you're going to pay in interest based off of your interest rate and based off the total amount and how long you're paying it off, and then see what is the total cost of that loan, or in other words, what is the total interest if you do nothing with that loan. And then if you do think that you are interested, which I would say, especially because you're all employees at an eligible hospital, look into public service loan forgiveness. There may be changes to that program, but typically what will happen is people that are already enrolled or have started the process would still sort of be in the process. That tends to be the case with other changes that the federal government has done when it comes to financial aid. And if you decide, what, maybe you've paid off most of your loans and you only have, like $5,000 left, or an amount that you feel like I could just get this done in the next year or two. I don't want to wait for public service loan forgiveness. Or maybe you don't qualify, maybe you're only working part-time, or for other reasons you don't want to do federal forgiveness or don't qualify, then look into possibly refinancing. I will say with refinancing, don't know what's going to happen with the rates. It'll be interesting to see what happens in the first couple of months of the year when federal rates go back up. Right now, there's not really a competition for private student loans because no one's really refinancing if they have a federal student loan. Why would they? You're paying 0%. You don't have to make a payment. So you're not getting that volume. So lenders, private student loan lenders, they're not reducing their rates. They're not doing anything major because it's sort of, you don't have that audience of possible people that would want to refinance. But in January, when that rate goes up from the federal government, it'll be interesting to see what the rates are going to be with a private lender. If you do decide to refinance before the rates possibly change, because we don't know, I'm just assuming, I'm making it could change. We don't know if it's going to go up or down or what direction. But know that you can refinance more than one. So just like a home, if you refinance one, or a car, pretty much anything, you can refinance once more than once. So don't feel like, oh, if I refinance now, I'm going to miss out again. You can always refinance again as well. You just want to make sure you're paying things off and that your credit is in a good situation so that when you refinance, you get the best rate available to you, which ideally would be the lowest rate possible. And I do have a little disclaimer here because I know I go over a lot of information, but I do have to specify that it's general information. I don't know your specific information. So I really hope that this is a guide to help you go on to the next steps, either contacting GreenPath, going on the Federal Student Aid website. Someone put a really nice comment that this was helpful, and they never know what is fake and what is real, and I completely understand that feeling, and that is why we do what we do at the credit union, because we want to make sure that you're getting credible information. I didn't put it in the PowerPoint, but we also have a blog where we put a lot of information, especially when there are new changes about federal student loans, and that's just blog.hucu.org, and you could just find it off our website. But that's also, we go straight to the source and we get that information to you. But if there's anything that I can clarify, please let me know. I'm here for a couple more minutes to help you. And as a reminder, we are the Harvard University Employees Credit Union, so all of you are eligible to become members if interested, and we have the same products as a bank, but that biggest piece and the difference is that we're not for profit. We are all members of we are all here for the membership, and any profit that we make, we really give it back in the form of lower rates in loans, higher rates in savings, and then we do a lot of community work and a lot of just education for everyone, because if we're all doing better financially, it's just much better for all of us. And we got a question about where are we located. So we are located anywhere your phone is, anywhere your computer is. You can do everything with us remotely. You can borrow a mortgage, you can take out a car loan, do checking, savings, all online through our mobile or desktop. But you can also come to a branch. We have one branch in Harvard Square. We do have a branch at the School of Public Health in the Longwood Medical area. Unfortunately, due to COVID, it is currently closed, but we're hoping to be back there towards the end of the year. And then we have some other locations as well. We have one in Mass General Hospital, and then we have one at Assembly Row and at the Charles Navy Yard as well.